We're going to jump right into our next panel. We're going to talk a bit about online crowdfunding platforms. We've got a great lineup here. Rather than have me introduce them, what I'm going to do is ask each panelist, starting with Ryan, to introduce himself and just say in 60 seconds or less what their platform is and how it works. And then we'll get into questions.
Sure. Ryan Caldbeck. I'm one of the founders of Circle Up. And Circle Up is an online platform that connects individual investors and consumer retail companies. So we won't work with tech companies, which makes me very unpopular in this room. Just non-tech companies, so food, personal care, beverage, those types of things. Sorry.
Hi, I'm Kevin Smith. I'm one of the co-founders of Seed Change. We're a startup investment bank, or investment bank for startups. We find, vet, diligence, analyze, mentor, and advise companies from early stage through life, I hope. Somebody recently compared us to Goldman Sachs for startups, and that was okay except for the whole vampire squid thing.
I'm actually kind enough of an intro.
Hey, I'm Alex from Funders Club, and we started off to try to make fundraising, which is sort of like herding cats for founders, a delightful experience, which we're still working on doing, but making headway. And for investors to be able to invest in the best startups, and as you know, that's like finding a needle in a haystack.
Well, I'm curious for each of you, how do you go about finding opportunities for your platform? What's your go-to-market strategy? How do you put the signal out there to find those best opportunities? I'm curious to hear how you all think about that.
Sure. So that was part of why we came together to start Founders Club. In fact, so our team was a group of entrepreneurs and angel investors, and what we realized is people everywhere are starting companies. Obviously, here in Silicon Valley, that's well known, and then the tech hubs of New York, Boston, and so forth. But everywhere, and what we realized is if you could create a network of people who could come together and refer deals to a centralized platform, that you can actually see a lot of deals. And so we take advantage of that fact for Founders Club.
We're pretty different. Namal and I are the only people who really leave the office. We don't leave the office that much. It's just through a few little products. AngelList, anyone can create a profile and go there, and you'll probably go there not even to start fundraising in the beginning. You might look for a candidate or just want to have a presence up there. But then you'll come across another product, so you might apply to an incubator, and then we'll see the company that might bubble up. Or you might be syndicated by someone. Our syndicate leads, like Gil, they bring companies to the platform. So we just have the platform itself and then a couple of products that tend to bring in a lot of companies. And say we get about 1,000 new companies a week, come to AngelList and some portion of them actively fundraise.
It's just word of mouth. So in the consumer retail space, there's no VCs or investment funds that will invest into companies less than 10 or 15 million in revenue. So they are always looking for a solution. So in that particular industry, if there is a solution, they tend to come to you.
We get 43% of our companies from referrals, from VCs, other investors, other entrepreneurs. 43% come from accelerators. We work with a number of well-known accelerators around the country and sometimes outside the country. And the remainder come from university programs like at Stanford, MIT, and the others that have established startup programs.
And so crowdfunding is still a relatively new concept, and if you read a lot of the political doom and gloom, it sounds like grandma's are going to lose all of their money by investing in these risky startup platforms. How do you guys go about educating, aside from the accredited investor requirement, what sets you guys to qualify, vet, and evaluate people who want to participate on the funding side of your platform?
Yeah, we have a program that we institute from the moment you sign up to AngelList. You tell us a few things like how much of your net worth do you want to invest in startups, or have you invested in startups before, or have you worked in the finance industry? And we ask you a bunch of questions. And then from there, if you raise a few, if it seems as if you need a bit of help getting used to it, then we'll coach you, we'll limit, your investments, there's a bunch of things that we'll do. So we have a very extensive program that we've instituted over the last year for new investors. And other than that, a lot of investors educate themselves obviously around the net, but that's our main one. And then on the really negative side, we have a good review system by founders and whatnot to make sure that investors aren't only good investors are on it.
other approaches?
We, we noticed that there's a lot of people who are new to startup investing out there. There's also many people who aren't. And as an online platform, you're kind of getting folks from all sides. And so we also have a way of vetting out who is who, and based on who they are, offering them resources. We have an education center, for example, to help them come up to speed on startup investing.
We take only accredited investors like everyone else, but we're registered broker-dealers, so we have to go through a pretty detailed vetting process for every investor that wants to sign up on the platform. After that, we spend a lot of time with one-on-one relationships. We have a sales rep or investor relationship manager for everybody who signs up on the platform. We do a lot of education, webinars. We have people internally who do their own, our own research, people we've hired from as investment strategists and provide proprietary research that we can provide to investors to help them think about how to add this particular asset class to their portfolios.
And on the flip side, I was checking out all of your websites, and some of you have very different approaches to deciding what should be offered and featured or promoted on the platform. And how do you all think about vetting what you want to promote or show or highlight to the audience in front of you, of the potential funders?
So at Funders Club, we have always had a curated or vetted model. And so unlike being a platform that is meant to be open to everybody, we realized there was a place in the market for a platform that was working for startups that had reached a certain point. Typically our companies are post-launch, they're growing, they have shown product market fit. It may have only been a few months, so these are still typically pre-Series A companies. But they have reached a certain point. Typically, we're not the first capital in. This is sort of the money that's coming in after family and friends money. And so we saw that opportunity, and that's probably the biggest distinction in terms of us not necessarily being a platform that one can self-list on. It's more through referral.
Yeah, again, our approach is sort of a hybrid model, and anyone can sign up and create a profile, but two things happen once a company gets on the AngelList. There's a bunch of social information generated around the company. People attach themselves as investors or advisors, obviously team members and whatnot, and that information in and of itself, as it's spread out the network, as it appears in news feeds and newsletters and whatever else, is very useful to investors. As an early stage investor, there's very little information available about a company, so it's only rational to assume that if someone else moves in a positive direction, that they probably know something you don't, and you can take some signal from that. So the network itself generates a lot of information, just organically. And then we have a featuring process, and that involves a team of like 5 analysts during the week that narrow our list of new companies down to about 20 or 30 companies, and then we have a panel of VCs from all around the valley that come in every week and help us narrow that down. And then we'll feature 5 to 10 companies a week, and that means emailing them out to a lot of investors.
So we curate the deals as well. We accept about 2% of the companies that apply to Circle Up. There's 2 stages of curation for us. One is a data screen. So we've had thousands of companies apply to Circle Up. When they apply, they give us revenue, gross margin, valuation, etc. And so when a new company applies, we compare their statistics to the basket of companies we have in a given industry. And then after that, we have a team of former private equity professionals evaluate the companies before they go onto the platform.
We've seen something like 1,200 companies in the last less than, 10 or so months, and we've listed so far 16 of them. Every company that we look at has to hit certain metrics, hit certain criteria, and then we put them through a pretty detailed process of analysis by our in-house team of venture advisors, analysts, and lawyers. And once they get through the process, then we sort of move into the marketing phase. Again, very much like an investment bank does for any company that's IPOing, and go through a pretty detailed advising, diligence, analysis, and then marketing phase.
And what happens after someone gets approved and funded? Like how involved or what role goes off place for the post? That's once you brought something in the platform.
For us, it's mostly about the syndicators, the lead of the deal. they get really involved in the company. A lot of the time they take board seats. That's what they do. You know, we, as a platform, we just do the back office and whatever else. So we're not very involved as a platform. It's all about the syndicates.
We're a bit different, and so we see ourselves as institutionalizing individual capital. And so in that vein, we see ourselves as partners to the startup's success, so through exiting IPO. And because of that, we're there following on whenever possible. We're providing value-added resources like hiring, customer acquisition, advice, and so forth through both internally, but also importantly, and what is enabled by our network model is the resources of these thousands of people who are on the platform. And that's basically what we do.
We tell companies that we list that we're like Hotel in California. We never leave. We continue working with them after they're listed on the platform, after they're funded, and the goal really is to stay really close and continue to help them get to their next milestones, whatever it is. Of course, for most it's Series A or perhaps an acquisition. And the goal really is to stay, to do whatever we can by advising, by introducing them to tapping into networks that we have, helping them with hiring, whatever particular issue a company has at the time.
So we believe strongly we want to help the companies succeed after they raise money. We fundamentally don't think Circle Up will exist in 5 years unless investors are making money, and that means the companies have to be successful in our mind. So we work to do that both through the product and through partnerships. So we don't have a team of operating executives at Circle Up, but we will do things like form partnerships. So we have partnerships with General Mills, Johnson & Johnson, Virgin America, Procter & Gamble, and a number of others that work with our companies after they raise money to help them be successful.
And crowdfunding is still really new, and finance in general is heavily regulated. So how heavy is sort of the regulatory tax that you guys pay in terms of, on a day-to-day basis, how much of your day do you have to spend dealing with regulators, compliance, and all this?
There's a misconception out there. It's just the Valley and beyond, and the press and the tech press especially. And I think that just around the word crowdfunding, people should know that actually, as far as like equity crowdfunding is concerned, as in the spirit of the Jobs Act, that hasn't ever happened yet. The SEC is still writing rules. So everything that you see that's happening online is not with respect to people writing small checks online in investments. It's not using the Jobs Act. It's actually using a regulatory framework that was established decades ago. And so in that regard, as far as the regulatory burden that the platforms are facing, a lot of this was clear, the path was clear for us a long time ago. Maybe with the twist now of, hey, we're online, we have the powers of software, the power of networks, how can we make that even more efficient? So that's sort of how we see
it. We are also a registered broker-dealer, as Kevin is, and as a result of that, there's a lot of work to do with regulators. So it's not really related to the Jobs Act, but if you are a registered broker-dealer, you have to comply with FINRA, and there's a lot that goes into that. So it's we have our own in-house lawyer, to give you an example.
Yeah, what he said. Times two. Unfortunately, we have a number of in-house lawyers, and we're bringing in another one just to make sure that we're able to keep ahead of regulations as they change. It's one of the most heavily regulated industries in the world. True in every country or every large market in the world. It's just an inescapable fact of life.
For each of you, I guess one more question before we open up to the audience for a bit. What do you think is the biggest misconception about your particular business? Not crowdfunding, your particular thing that you do.
That's an easy one for me. It's that AngelList is full of angel investors. It's full of, as I said before, a heap of institutional investors, LPs, private equity firms, big VCs. And so you can go on there and maybe meet a VC to lead you around and then use the online stuff to bundle up a bunch of smaller investors. So AngelList is just, it's not all about small angel investors. It's the whole ecosystem is sort of on there in some way and using it in some way.
I would say for us, partly this is self-imposed because we describe ourselves as an online VC, but I think there's this misconception that we're somehow competing with all the other VCs out there, and that couldn't be farther from the truth. A couple of things. I mean, one, we have consistently been co-investing with, for example, SoftTech and Founders have been co-invested, but for looking ahead for the path of companies over their development, the whole ecosystem works together. It's not, especially at the seed stage, but even progressing through IPO, and different investors depend on each other. And so we've been actually, there was an article in TechCrunch that was saying something like Sequoia should send Funders Club flowers. I think that was the actual quote. And I think they were citing the fact that Sequoia's followed on to at least one of our companies, and there's a bunch more, Andreessen and Union Square Ventures and First Round Capital, like all of these names in the business who've been around for a long time and who have successful track records are also there funding these companies later on. And so I think that while that misconception has been out there, in actuality, if you look at the activity that's been happening with us, we're working hand in hand with everybody. And I would view Funders Club as opposed to being a competitive force in the space, as we're trying to help bring the industry online.
I'd say the biggest misconception is that we're actually crowdfunding. Nothing we do relies on any of the new rules of the Jobs Act. Everything we do is really, as Alex says, prohibited by regulations from the 1930s. We're very much focused on being fitting within the existing framework. And as I said earlier, we have pretty high minimums for investing on the platform. We have a decent hurdle and application process for investors getting on the platform. We're not targeting. I've told everybody in my family they're not welcome on our platform. It's not the right cohort that we look for.
I think the biggest misconception about us is probably about the industry that we play in, consumer retail in general, which is mostly here in Silicon Valley, there's a perception that if you're not a tech company, you're a mom and pop business that is there for the fun of it. The average company that we work with is more than $1 million in revenue, growing at more than 100% a year. And I would argue that's a larger, significant business. Typically has national distribution. So these are real companies where the historical returns in the space have been extraordinarily strong.
So we will open it up to some audience questions and our stuff.
Any questions?
So you sort of talked about how you're not really doing crowdfunding. If and when Title III does go through, what do you actually expect to see happen? And what do you expect to see change?
I could start. We almost certainly will not work with Title III.
Can you explain Title III?
Sorry, yeah. Title III, the Jobs Act, which passed in April 2012, will allow unaccredited investors to invest. The problem, at least from our standpoint, is that the rules have been written in such a way that it's very difficult for companies to take advantage of it. So they're very onerous rules, which we can get into if you guys want, but we're skeptical that good companies will be able to raise using that because the rules are so difficult. So we likely won't do that.
Ryan keeps taking away everything I would say. I actually think we talk frequently with people inside the SEC and at FINRA as well about the rulemaking, and I'm a little skeptical that the rules, when they finally come out, that the rules for crowdfunding platforms, for instance, are going to be much different than the rules for broker-dealers. The changes aren't going to be as great as I think people hope for, and therefore that's not going to filter down into the financial industry and into the markets as much as people are expecting.
No, I mean, I don't know how much to add to that. It could be amazing, could not. Who knows? We'll see.
I would take a step back too and point out the Jobs Act is one specific piece of legislation. So we could have a conversation about just philosophically, does it make sense for non-accredited investors to invest? And I think most people would say that generally kind of makes sense. In other words, our society lets all people gamble, go to Vegas and bet on craps. but you're not allowed to bet on or invest in startups. And I think that's something that just fundamentally will eventually be resolved. Whether or not that's through Title III of the specific piece of legislation or not, you can hear some of the opinions that are being expressed. And you know, these things do take time, and regulatory change does take time.
Since we were talking about crowdfunding, I guess I had a question about timing. We've done a couple successful crowdfunding projects. We're wondering at what point somebody like us should come talk to you guys. Should we do another third one? Should we do a fourth one? Should we talk to you guys now? Should we, somebody else in the audience, do it before they even do a crowdfunding project? Like, at what point does it make sense to talk?
Could you say that again? We had a hard time hearing what you said. Could you give him the mic back so you can repeat the question? We didn't catch it all.
My question was, we have done a couple successful Kickstarter projects, and we're wondering for us or for anybody in the audience, at what point does it make sense to come and talk to people like you guys? Would it be pre any kind of project? Would it be after the first, after the second? Should we do a third? Like where, at what point does it make the most sense?
It's amazing how all these things are coming together. You know, the question for those who couldn't make it, for those who couldn't hear, you know, when do you do Kickstarter style crowdfunding versus equity crowdfunding? As we know, it's not actually crowdfunding yet. I mean, when you want to sell some of your company, basically. If you can keep going and keep selling stuff on Kickstarter and keep getting people to buy, like pre-buy your products, you can do that, then you should keep doing it if that's enough to keep the lights on. But if you want to start selling some of your company on the promise of like a lot of growth, then it's worth seeing what price you can get in the market. More practically, we see a lot of companies go and have a great Kickstarter campaign, maybe for a couple $100,000, then come into AngelList, and investors take that as a very strong signal. I mean, depending on the production timelines of what you're making, depending on what the backers have actually been promised and all that sort of stuff, if it's relatively short-dated and it represents more of like a sale of your product, then that's traction. And you're probably in a good spot to raise some money.
Yeah, I agree. We actually recommend to a number of companies that have come to us interested in listing and raising around that they start at some place like Kickstarter first. I think it's a great entry into marketing, branding, developing a customer base, and of course getting a little bit of revenue. And it serves as a traction signal for investors. It's important for us.
As like founder advice, founder at 30. I think that one thing to keep in mind is consumers' interest and enthusiasm for a Kickstarter, Indiegogo, or that kind of campaign is expression of their connection with what you're painting the vision of, right? In other words, they haven't yet experienced your product, you haven't yet built it or delivered it necessarily. And that's at least in the pre-sales case. And so I think there's two things. One, that's great, that means you're getting validation of like interest, but on the other hand, there's a lot of gaps that have to be closed. And so with Foundersuite, what we've seen is we've actually worked with a number of companies who very successfully, had multi-million-dollar campaigns through product crowdfunding, rewards-based crowdfunding, and still there still are things such as needing to do operational development to deliver, to build a real company, which is often different from just producing and selling a product, where it can work hand in hand. And I would say that's not unique to, by the way, online crowdfunding. That's true of all offline VCs as well, being potential partners for people who have had successful Kickstarters and are looking to build a real company around that. I would echo what Ash says too, which is like, in general, just founder advice, if you don't need to raise money, like, probably shouldn't. If you can keep growing and think that the extra money would really make a big delta for you, a big change.
Well, I want to thank our panelists for sharing their thoughts.